Welcome back to the channel, starting off with the giveaway. So if you want to win $20, simply like the video, then comment below your 10x company over the next decade and why they're going to be a 10x company, and I'll be choosing the winner by random. Let's get into it. Paying a solid dividend since 1985, none other than Wesfarmers, ticker WES on the ASX. Current thoughts: price too high for my liking, so I won't be buying any at the moment, though I will be keeping an eye on it for years to come for any buying opportunities. Why is the price so high? Because I would argue that Wesfarmers' main company, Bunnings, has the biggest moat in Australia. If you can name a company with a greater moat than Bunnings, please leave a comment in the comment section below. Their moat has been tested by another chain called Masters, who failed miserably. There's only enough room in Australia for one Bunnings, and that is Bunnings. I will now pass on to Sue Mitchell to explain why Masters failed. Please skip this if you don't want to watch it, or watch it if you want to watch it.
There are half a dozen reasons why Masters has failed. First of all, the concept. Instead of opening up one store at a time and making sure that that store was going to be profitable and that it would appeal to consumers, Woolworths went out and snapped up dozens of sites. It opened 15 stores within the first 12 months. It opened 50 stores within 4 years, and it's been a complete debacle. The second mistake was the stores. Woolworths struggled to find suitable sites, especially in metropolitan Sydney. Most of the best sites had already been snapped up by Bunnings. Third was the product range. Woolworths tried to differentiate itself from Bunnings by stocking low-margin products such as white goods and home decorator products and making its stores light and bright. But the format just didn't appeal to trade customers, who account for about a third of the market, and customers perceived its prices to be higher than Bunnings. Fourth, the relationship with its US partner, Lowe's. It quickly became clear that Lowe's just didn't understand the Australian market, and it soon found that there was no demand for its thousands of gun safes or snow shovels in the middle of summer. Lastly, perhaps Woolworth's biggest mistake was in underestimating the aggressive competitive response from Bunnings and being overly optimistic about the prospects for Masters from day one. The business lost $245 million last financial year, taking losses over the last 4 years to $600 million, even though Woolworths and Lowe's have together invested more than $3 billion into the venture. The architects of Masters have now moved on, their reputations are in tatters, and the chairman of Woolworths, Gordon Cairns, has taken a more realistic view of Masters' prospects and has wisely decided to pull the plug.
And what widens their moat is, it's in everyone's mind, oh, you can get that at Bunnings. Yeah, Bunnings will be cheaper. Yeah, just go to Bunnings and grab it. Yeah, I got this rake from Bunnings. Where'd you get that? Bunnings. Oh yeah, I got mine from Bunnings too. So the company is owned by Wesfarmers. I'd love to just buy Bunnings by itself because it's easy to understand, good business, one of the top businesses. All these other ones are just mediocre, in my opinion, though they probably make a bit of money. So look at this: revenue up, net profit after tax down, but still $1.6 billion year in, year out. Dividends per share down, fully franked. Okay, what else we got? Salaries, they're paying people money. You coming in, so they're paying this much salary and they're making this much profit. So it seems like a fair deal for everyone. Paying their taxes, community contributions. Not to mention all the people who probably steal from Bunnings, getting their own contributions. And they're still making heaps of profit. Helping the indigenous, increase in recycling, reduction in landfill. They do it all. How big Bunnings is compared to the rest of their companies. So it looks about 60% of the pie there. Kmart coming in second. Officeworks, Wesfarmers, chemical, energy and fertilizer, and industrial and safety, small little slither. So another highlight: revenue growth of 14%. Total store sales growth 14.7%. Store-on-store sales growth 14.7%. So it looks like they didn't have any more stores, and each store rose the sales growth by about 15%. So in conclusion, just something to keep in mind that Bunnings is a good business, so next time there's a crash from the Rona, or like there was in 2008, I'd be happily putting money into Wesfarmers and just holding on to them, and so going to be paying dividends from years to come. Also, if I still win a lot of money, I just know that Wesfarmers is a sure bet. Obviously wouldn't still wouldn't be putting money in at this price. Maybe a little bit, and then a little bit more as it goes up with the revenue growth and sales growth. And if it was to dip down quite a bit, then I'd put a bit more in. But it's just one to nose there for safety. A good backup, you know.